Hey guys, my name is David, and in this series, we will be going over how to read and analyze the three main financial statements that you will be encountering in your investing careers. These statements consist of the balance sheet, income statement, and cash flow statement. Companies typically release these three statements quarterly and provide investors with a ton of information on how that company is performing over time. In this video, I'll be breaking down the balance sheet in its entirety and highlighting the major components found in the statement, as well as detailing what I look for specifically in those components to determine whether or not a company is a good or bad investment. In this video, I'll be using Foot Locker's balance sheet as an example, as it is one of my investments at the moment. Let's get into it. One thing to point out before we start looking at all the numbers is that the statement says all the numbers we will be seeing are in thousands, which means that numbers which look to be in the millions are actually in billions. With that in mind, let's look at the company's most recent report, which would be under the January 2020 column. Under this column, the balance sheet is divided up into two main sections: assets and liabilities. In every balance sheet, a company's assets are always listed first and are ordered based on their liquidity. For those of you who are unfamiliar with this term, liquidity is just how fast someone is able to sell off their assets to someone else and convert those assets into cash or cash equivalents. For example, you could sell off your investments in a company way faster than you could sell off your property, for instance. Therefore, it is no surprise that the item listed first on Foot Locker's balance sheet is cash and cash equivalents. Foot Locker doesn't have any short-term investments, but if they did, it would go right under cash and cash equivalents and increase the bolded section called total cash. This is only a part of this section called current or short-term assets, which represent all of the assets a company can liquidate to cash within a year. Now, let's look at receivables, which Foot Locker has around $100 million under. Receivables represent any money that is owed to Foot Locker from other sources. Next, we have inventory, which is just the amount of stuff, in Foot Locker's case likely shoes, that the company has yet to sell but has already produced. Foot Locker has a whopping $1.2 billion of unsold inventory. This might seem like a lot considering Foot Locker's relatively small market cap of $2.4 billion, but it's completely normal in the retail industry to have a sizable amount of money tied up into inventory. The rest of the current assets consist of money the company is owed back for various reasons, such as deferred income taxes, which means Foot Locker paid more than was necessary for their income taxes, or prepaid expenses, which represent the expenses they incurred that did not yet provide them with any revenue. In total, we can see that Foot Locker has a whopping $2.4 billion in current assets, roughly half of that in cash or cash equivalents. Let's move on to Foot Locker's non-current assets, which consist of long-term assets that benefit the company. The first section under non-current assets is property, plant, and equipment. This represents all of the physical stores and equipment that Foot Locker owns in order to keep their business running. So Foot Locker has around $5 billion under this section, but we need to factor in how much these assets have depreciated, or in other words, lost value over time, which when subtracted from their property, plant, and equipment figure leaves us with around $3.8 billion in net value. Below that, we have goodwill and intangible assets. Now, typically, these sections are dedicated to a recent acquisition or investment in an intangible asset. They can also display the value of a company's brand, intellectual property, as well as customer relations. In Foot Locker's case, they have a very strong brand, many investments in intangible assets, as well as amazing customer relations. Still, these assets are often discounted for good reason, as their values are determined based on company's discretion, and if for whatever reason Foot Locker were to try and sell these intangible assets, it's unlikely that they would be able to sell those assets at their recorded value in the balance sheet. Under that, are just other assets that are owed to Foot Locker in the future, such as prepaid pension benefits and more deferred income benefits. In total, Foot Locker has roughly $6.6 billion worth of total assets, meaning around 40% of the company's assets are current assets. Now, let's move on to the liabilities section of the balance sheet, which represents all of the money Foot Locker owes to others. The first thing we see here is current liabilities. Again, we need to remember that liabilities and assets are both ordered based on liquidity. Now, unlike current assets, current liabilities consist of debt that must be paid off within the next year. The first section we see under current liabilities is capital leases, and capital leases represents all of the money Foot Locker dishes out temporarily to own a physical asset, such as their stores. And this has increased by over $500 million from 2019, which is definitely not normal. There is, however, an explanation for this, and after doing some research, I believe the spike is due to new reporting standards. We can see that the company increased the non-current asset gross property, plant, and equipment significantly from 2019 to adjust for this change in reporting standards. Underneath that, we have accounts payable, which is just money Foot Locker owes to its creditors and suppliers. The company has around $330 million, which has stayed really stagnant over the past few years. Taxes payable is just as it sounds, taxes Foot Locker needs to pay within the next year. Accrued liabilities are expenses that the business has that have not yet been paid for and is another form of debt, and a relatively significant one for Foot Locker at that. Deferred revenues represent any revenue that the company has received, but they either haven't delivered the product or service to the customer or have not incurred expenses for that yet. In total, Foot Locker has $1.2 billion worth of current liabilities, and we've approached a very important ratio that many investors calculate that compares a company's current assets to their current liabilities. This ratio is one of many liquidity ratios and is called the current ratio. The current ratio is calculated by taking a company's current assets and dividing it by their current liabilities. It tells us how easily a company will be able to overcome short-term temporary financial struggles. The ideal ratio for any company to have is a 2-to-1 ratio, meaning they have twice as many current assets as they do current liabilities. Foot Locker actually has a near perfect 2-to-1 ratio, which is a very good sign and tells investors that Foot Locker's liquidity is very solid. Moving on, we have non-current liabilities, which, similar to current liabilities, has a significant increase in capital leases for the same reason. Other than that, we have deferred taxes, which is just the amount of taxes Foot Locker must still pay, pensions and benefits, which the company must pay, and other liabilities, which add up to be around $120 million. Overall, we see total liabilities add up to just over $4 billion, which is $2.5 billion less than Foot Locker's total assets. When we subtract total liabilities from total assets, we get something called stockholders' equity. Stockholders' equity is the amount of assets left over once all of a company's liabilities have been subtracted from it, and we want to see this number growing or staying stagnant over time. If a company's current or non-current assets are declining, but their current or non-current liabilities are increasing, this may mean that the company will not be able to pay off their liabilities in the future and is a very concerning sign. Thankfully, Foot Locker stockholders' equity has stayed pretty stagnant over the past few years, and their liabilities and assets have been moving in the same direction each year. Stockholders' equity can also be converted to book value per share, which tells us the value of the assets within a company per share. Foot Locker has a book value of around $23 per share, which is absolutely outstanding. And if the company had to liquidate or be bought out for whatever reason, shareholders can look to receive around $23 worth of assets per share that they own. I hope this video helped you guys better understand all of the components of a balance sheet and what to look for when analyzing it. Be sure to like and subscribe if you guys enjoyed, and check out my next two videos in this 3-part series. And as always, have a wonderful day.